All right, and we are live. My name is Jared Sparr. I want to say thank you, everybody, for joining us. I am the founding member of the Restaurant Business Advisors Group, and this is the module on alternative financing. I wanted to start out by kind of having people ask a question to themselves. Did you know that every year 9,000 restaurants fail in their first year of business? And the reality is that's a true number. 9,000 businesses or 9,000 restaurants fail every single year. And what we've done is design these modules to help you be the businesses that succeed against all the odds. So with that said, we've created a number of different modules for brand new restaurant owners to help them avoid the pitfalls, help them save money. And this one specifically is about alternative financing. You can get more information on this module and contact information from our website at restaurantbusinessadvisors.com. All right, so tell you guys really quickly about myself. Again, my name is Jared Sparr, and I'm the founding member of the group. I'll be your presenter today, and my specialty is cash flow. My tagline is I'm a life preserver for your cash flow, and I'm basically a cash flow consultant for restaurants. And the person that I'll be interviewing for alternative financing is Doug Mitchell. He's the owner of CAD Credit. And just in case you didn't get it or you don't have the screen on, his phone number is 248 238 8636. And Doug, can you tell me a little bit about yourself?
Sure, Jared. I'd be happy to. I graduated from the University of Dayton with a Bachelor of Arts degree and immediately went into the life insurance business as an agent and spent 22 years with Northwestern Mutual. The last 10 years or so of that time, the vast majority of my clients were private business owners. However, I did do funding on excess benefit retirement programs for several large publicly owned corporations. I also like to tell people that while I was with Northwestern, I attended Walsh College's Master of Science in Taxation program. I left the life insurance business to start my own business in creative financing, and through that business provide funding through non-traditional financing to privately owned businesses. My clientele includes numerous startup organizations and also existing companies who are expanding. The range of financing that I've helped secure is from 20,000 or so into the tens of millions. And I think that pretty much covers the basis, Jared.
That's perfect. And just to give our audience a little bit of a background, I've been working with Doug for, I don't know, it's been probably like 7 years now, I think. I met Doug with a previous business that I owned, and I can say nothing but good things about him. One thing, as far as a tagline for Doug, is that he can help you get business credit without having a personal guarantee. And I think that's the creative part of doing alternative financing. All right,
Thank you,
so
Jared.
no worries. Um, so the loan is based on the business credit and not on the personal credit. So kind of explain to me, if it's not based on the personal credit, how you get the loan and what it's actually based on.
Well, our programs are based on whatever the strengths that our client's business actually have. And to amplify that a little bit, I'd like to add that we use strengths as falling into one of four categories that we like to call the four C's. The first one would be personal credit. The second would be business credit. The third one is the cash flow the business might have. And the last of the four C's is collateral. And basically, any business that can show some strength in at least one of those areas can obtain funding. Obviously, the more of those categories a business is strong in, the more money it can obtain. And I'd like to give you a few examples of each if I could, Jared.
Yeah, certainly. And just for our audience, just kind of a preparatory thing. I know that Doug will get into this in more detail, but he actually has a system that shows you exactly how to do this. So I'm sure you'll explain that more. So tell me about the first C, the personal credit.
Okay. When people hear personal credit, they immediately think of the official credit reports from the credit reporting agencies, credit scores, and that sort of thing. However, there may be a lot more to it than that in any particular situation. One time I heard a bankruptcy attorney use the phrase debt of honor. And he explained to me that the meaning of that was that it was a debt owed to a relative or a close personal friend that would be repaid based solely on the relationship without any regard to whatever legal consequences or occurrences happened. In short, someone just wanted to help based on the relationship, even if there was little or bad credit showing on the borrower's credit report.
So that's something that you can show a customer how to demonstrate to get some financing, basically.
Yeah, and I think we're going to get more specific a little bit further on in the presentation.
Okay. And the next C was the second one, that's business credit. Tell me more about that.
Okay. Well, the business itself, totally independent of the owner or owners, can also build a formal business credit profile and a business credit score. Dun & Bradstreet, Experian, Equifax all maintain business credit profiles that are independent of any person. With a sufficiently strong business credit profile, the business can obtain funding on its own. And kind of as a gross generalization, consider that large publicly traded corporations borrow billions of dollars every year, and none of those debts are guaranteed by any of the officers of the corporations or any of the shareholders. So it's a matter simply of knowing what are the standards to obtain funding based on your business's own credit, and then arranging your business so it meets those standards.
So kind of some insider's tips and tricks, and I know that's been elusive for me as a small business owner. All right, the third C is cash flow. Tell me how that plays into it as well.
Well, basically, any business that can show some history of regular cash flow can use that stream of income to obtain funding. Arranging this is normally going to involve a customer who is the source of the cash flow or some third party participating in the financing arrangement. However, the necessary cooperation by either of these is a lot more common than most business owners realize.
Interesting. And I just think of cash flow as, like a report that you print up, and I think you put it into real world use. So it's a good way to use it for sure. And the last one was collateral. Tell me how that fits in.
Well, collateral basically is anything that has an independent value all on its own. Now, I don't necessarily mean just physical assets such as equipment and fixtures, although they are collateral also. But there are many, quote, paper-based types of collateral, such as accounts receivable, contracts, invoices, etc., that may be sufficiently strong and large enough to provide funding that a business is looking for.
Okay. And that's something that we discussed, I think, when we were working together early on, was like account factoring on your net 30. So, there's different ways to approach any different problem, and I think that's one of them. All right.
Right.
So, um, one of the things that I think is a big question for you is, are non-traditional loans mainstream? Like, is it something that we think of as loan sharking versus like a traditional loan? And how does, you explain this to me, and I think you can probably get it to our audience a little bit cleaner than I could. So tell me how your loans are not basically loan sharking, how they are mainstream loans.
Well, a lot of people ask the question, is the creative or non-traditional financing programs more expensive than mainstream loans? And the answer succinctly is probably, but possibly not. It depends on the circumstances and the program. But I like to point out first to business owners that they can't really compare it to personal credit. Commercial financing and consumer financing is an apples and oranges comparison. Let me give an example. When publicly held corporations go public or sell stock, or they issue a bond issue to raise money, the current going rate that the brokerage firms charge in fees to bring that to the public securities markets is 15%. Now, by contrast, I don't think any consumer is going to pay a $1,500 fee to open a credit card with a $10,000 limit, or pay a fee of $15,000 to get a $100,000 mortgage on their residence. So you have to really consider what you're doing when you consider business financing, and you have to look at it as commercial, not consumer.
Yeah, I think that's a mistake that most new business owners make. All right, and you had one example that you wanted to show us. Kind of regardless of what cost might be, it's the business owner's job to evaluate it and kind of compare apples to apples. So tell me a little bit more about what the responsibilities are for that business owner.
Okay, well, let me give an example of a situation I was involved in several years ago regarding this whole cost issue. In this situation, I was working with two guys who had a startup business that was a leased employee company. They provided registered nurses to local hospitals and nursing homes on a temporary basis. Each owner had prior experience in the form of working as an employee for a similar business, so they knew the business well. They knew the parts of the business. They knew customers, suppliers. They knew a pool of nurses. And between them, they managed to raise $150,000 of cash to start their business. Things got off to a boom, and at the end of the third month, they were very low on cash, but they had built a great accounts receivable asset because the average time it took these hospitals and nursing homes to pay the invoices was 78 days. All their nurses, however, expected to get a paycheck on Friday. And further, if you analyze from a financial standpoint their business, there was really a cap put on their business by their $150,000 capital. Mathematically, with the 78 days to receive payment on an invoice, they could not do more than $900,000 a year of revenue in 1 year. And they couldn't produce more than a $255,000 profit based on that. They approached several banks, but each one told them they needed to be in business for 2 years before they could get a line of credit of the size they wanted. So I worked with them to establish a factoring arrangement whereby they sold their invoices each Friday for cash at a discount to a commercial factoring company. And the factoring company waited the 78 days to get paid. However, this arrangement put most of the cash in the client's business almost immediately, not 2.5 months down the line. And of course meant they could pay more nurses each Friday, and thus they could do more business. So to get back to the cost that you were asking about, although factoring is a sale, you can do some math and calculate what the equivalent rate of interest would be if it were a loan and the costs in terms of fees or discounts were that interest. In their case, it turned out to be the equivalent of about 30% interest had it been a loan rather than a sale. In the first year, therefore, they arguably lost $180,000 due to taking those discounts. And regularly, they had about $600,000 of invoices that they had sold but were still awaiting payment. So to answer the question on the cost, was this worth it to them? They ended up their first year after, quote, losing the $180,000 by the sale of the discounts with a profit of $595,000. Now that's $345,000 more than their seed capital would have allowed them to make.
Yeah.
And I think most people would agree it was worth it.
Yeah, and what I've seen with a lot of owners that I've worked with personally is they do things like they'll take a personal credit card advance, and the math on that is actually higher than that 30%. So, realistically speaking, you want to do some research and find the right one as an owner, but you also want to, work with an advisor who knows the options, who can show you the numbers and show you how the numbers work for your benefit. So, you're the person to work with.
Well,
Okay.
thank you.
It's just been my experience. um, and then I think another tool that the owners use is retirement plans, and they, either they pull money out of those, and I think there's some tricks that come to that it's not as easy as it sounds. I think you can help with that. So tell me about that type of opportunity there.
I'd love to. This is an area that I get extremely excited about. I noticed in some of your literature, Jarrett, that you talked about people cashing in their 401ks or IRAs to start their business.
Hmm.
And basically what I'm going to address here is methods that they can use that same money and not have to close the accounts and or pay early withdrawal fees, etc. But it certainly is an area that not only they can use, the business owner, can use their own retirement funds, but people they know can also participate various ways with IRAs that are possibly 401ks to participate. And if you think about it for a minute, most people have the 401k or IRA invested in mutual funds. The
Hmm.
mutual funds then turn around and invest in stocks or bonds of various types. And if you think through that, you realize that the money ended up one way or another invested in a business, either as an ownership through stocks or as a loan through bonds. The same thing's possible with small privately held businesses rather than just all publicly held stocks or, New York Stock Exchange bond kind of things. I do want to stop here for a second with a cautionary note. There are very specific rules and procedures that must be followed when you use retirement plan money to fund your business. There are some restrictions prohibiting investments with certain close relatives and some specific investments which are prohibited. And it's extremely important to follow these rules. But there are far more opportunities, and the vast majority of people, including some professionals, don't realize exist. Next, I'd like to mention that this strategy can be used with business owners, friends, partners, business associates, and even potentially their employees' retirement accounts, as long as those people are interested in investing in the business. Let me give you an example of a situation I was involved in personally several years ago when real estate was still a growth investment. I established an LLC and approached a number of other real estate investors I networked with to invest money from their IRAs into the LLC, which would then buy and flip single-family houses. 100% of the funds that went into this LLC came from somebody's IRA.
Hmm.
The LLC bought properties for cash, did no financing, paid for renovations with cash, and when it came time to sell the property, the LLC also had the ability to do some more creative financing things than would be possible if there had been a mortgage in place.
Hmm.
It's not necessary for the business to sell an ownership interest in itself, like stock or the shares in the LLC I did, to use this strategy. Arrangements might be made to use the retirement plan from somebody you know to finance just one or several parts of your business. For example, you could have someone's retirement plan purchase your equipment and lease it to your business for monthly payments for 3, 4, 5 years, whatever. Earlier I mentioned clients who had factored invoices to hospitals for the leased nurses arrangement.
Hmm.
There's no reason a retirement plan couldn't buy those invoices at a discount rather than using the commercial factoring company. Maybe you could even negotiate a smaller discount rate with someone you knew who was comfortable with getting paid from a large local hospital. Similar arrangements are possible with leasehold improvements, inventory, an entire building, contracts, and much more. In summary, this is a very creative area with lots of opportunities and possibilities. If you or someone you know has confidence in you and is willing to invest their retirement plan money in your business.
Hmm. And the question that pops up in my mind, because this is something that we haven't talked about a ton, and I'm actually learning myself on this one. Um, for a brand new restaurant owner, is there a time frame? Like, do they have to be in business for 2 years in order for this to work?
No, is the short, simple answer.
That's awesome.
Um, most of the loan requirements, like earlier I mentioned, the lease employees people went to banks and they were told repeatedly you have to be in business 2 years. Those are standards that banks have decided to establish. There's no reason, and it happens occasionally. I mean, think of Facebook, just went public here a year ago.
Hmm.
They had billions of dollars of financing and had not turned a dollar's worth of profit. There's no reason that money can't be lent, to a brand new startup business out of a retirement account or any other way.
I think I just thought of another referral for you. We'll talk about
Well,
that
thank
after
you.
the
I'll
interview.
take it.
Our next question, or my next question for you was, and I know there's not a best program because you can't, each situation's different, but do you have a favorite program?
Well, you heard the excitement I had on retirement programs, but I have a hard time calling that the favorite one because every situation doesn't work out that there are retirement plan or plans or relationships with people who have them to make that available. I really think the most important objective is to get the funds necessary for the business owner I'm working with to either start up or to expand their business. That has to be done based on the things that are available to work with, and that goes back to the business strengths we talked about earlier. So you secure the money based on whatever basis you can get it on. Beyond that, another thing I'd like to say is read the annual reports of several publicly held corporations and ask yourself, should my company be doing these things? The point I'm trying to make with that is that publicly held corporations employ just legions of MBAs to consistently work on all aspects of their financing. And what you're going to see is, for the most part, they do everything they can to get all the money they possibly can. They go to the stock market and sell stock, and when they get done with that, they go back and sell bonds. Then they go to banks and arrange traditional bank lines of credit on top of that. They might also do lease buyback transactions on equipment or some sort of receivables financing. They work very hard to arrange financing for their customers' purchases so they get paid all cash even if the customer ends up paying over time.
Mm-hmm.
In short, they use every avenue available to them to raise as much cash as possible. And I guess I'd add to that if you do look through these reports, oftentimes you're going to see a thing called number of days of cash on hand.
Mm-hmm.
What that's reporting for these publicly held companies is the period of time they could pay all their bills, all the salaries, all the costs, even if their income stopped. You might be surprised to see a good number of these companies maintain close to 6 months of cash on hand. Wow. And with that amount of cushion, it gives any business time to look at options, compensate for the bad things that have happened, or to evaluate alternatives or to change direction.
Yeah, I think smaller business owners don't have anything close to that. Just the nature of the business.
I'll add something that hit me just as you said that. I think it's a big mistake, but it is really common with small business owners. The mistake is, I want to borrow the minimum amount possible because I don't want to lose the interest. And then when the first thing goes bump in the night, it makes borrowing harder. If you have somebody who borrows way more than they need, they've got the money when something goes bump in the night. And if their credit gets dinged or their income goes down, they've already got the cash available. And that's the point I was trying to make with seeing 186 days cash on hand in annual reports to publicly held corporations. They
Wow.
know this.
It's one of the things that I have in my ebook that I have for my business in general is I say that banks don't want to loan money to people unless that the individual who's looking to borrow it can prove that they don't need it. So one of the advices that I give is, when your business is strong and you don't need the money, open up a line of credit. And then when you do have a situation where you need to borrow it, you don't have to borrow the line of credit typically. and there's usually no fees to have it, but it's available for you when times do get rough. And that's, planning ahead is just a big part of, I think, staying in business.
Exactly.
All right.
Exactly.
So, I think there's a lot of variety and a lot of information you've given us. But I also think just the term alternative financing is scary to some people. So what can you tell us about risk to make some people feel more comfortable?
Well, the program that I have available, Jared, is highly structured, and it's been developed with a lot of input from a lot of professionals um, to find the best fit for any business. First of all, there is a structured computerized program that the business owner puts his own business information into, and then the computer program does the analysis to find out what might be available in their current individual circumstances. It looks for the strengths of the client's business and makes suggestions based on those. The most important part, however, is there's live personal help available. Each client gets ongoing access to two separate groups of certified professionals. The first set of trained professionals are the business credit specialists. They answer questions and provide guidance as to what the business owner needs to do to establish a solid business credit profile and a business credit score on a step-by-step basis. You have unlimited access to these people. They're available most normal business hours. English is their first language.
Important.
You can call them up anytime you want, as often as you want, on an unlimited basis. The second group of advisors are the funding advisors. These people know the ins and outs of the various programs available. There's the ones we've mentioned so far that have gotten dozens of loans of different types for various people.
Okay.
They have available over 30 different types of arrangements. They have 400 different funding sources, and the funding advisors will guide our clients through the program and stay involved until the funds arrive. These funding advisors are included for 5 years.
Hmm. And I know that
So
program.
I was trying to make the point, on the risk that there's a lot of hand-holding going on here. People are
Yeah,
going to know what they're getting into, what their obligations are, what they're getting back before they have to make any commitment.
which is perfect because that makes you feel more comfortable when you have the knowledge. That program or that system that you're kind of describing there, we have it outlined in our Restaurant Business Advisors ebook in pretty good detail. And if our listeners haven't read that ebook, it's available at the website. It's restaurantbusinessadvisors.com. And in the next slide, we're going to give some summary information, but you can also contact Doug directly to get more information on that as well. So, is that it on risk, Doug?
Yeah, I think we pretty well covered it.
Okay, cool. And then the last thing is a summary. So for our listeners, you can tell that there's a lot of different resources available for you when it comes to financing and alternative financing. And I think a lot of it is just doing the research and having the knowledge to know which one is the best for you and which one's going to have the best return on investment, be the safest for your situation. And also keeping in mind the four C's: the personal credit, business credit, cash flow, and collateral. So for more information, you can, again, go to our website, the restaurantbusinessadvisors.com, or contact Doug directly. His phone number, in case you don't have your screen up, is 248-238-8636. And that's pretty much it. Do you have anything else to add, Doug?
No, it's been rather extensive. I really appreciate the opportunity of your having me today. And the other thing I do is just commend you on what you're doing here for new restaurant startup owners. We've had several meetings leading up to this, and you have been extremely thorough, and I'm very impressed. You're doing an excellent, excellent job.
I appreciate that. Yeah, our goal is to build customers for ourselves so we can help our customers be successful in every way, and that way we're going to be successful long term as well. So thank you for your time, Doug.
All right. Well, thank you again for having me. You have a good day,
All
Jared.
right, bye bye.